Hello?
Hey everyone. Yeah, no,
Hello?
we're on. Okay, today is August 2nd, and we're going to talk about today, obviously macro, but specifically Josh wanted to talk about the market, big picture things here, and there were three things I think in particular you wanted to go over. So that's it, Josh. I'll let you take it away.
All right. This is quite a rare occurrence, but right now I believe the contrarian play is to actually be long this market. And I say it's rare because normally at record highs, everyone is bullish market, but not right now. You're you're seeing everybody talk about, oh, this is the market top, or just how overvalued everything is. And if we look at the fear and greed index, we see that right now we're at extreme levels of fear, while the market just hit an all-time high. And to me, it just shows that the market still has quite a bit to go. And I say that because the masses are never right. And if the masses are worried about a market crash, I can almost guarantee you the time is not yet coming. And I don't think you should be over leveraged going long this market. And especially there's certain sectors that I would be wary about, because if we look at what's happened in the market right now, it's pretty much two things. If you've been lost past few months, you've made money. Anything else, you've lost money. You couldn't be long volatility. Value stocks have gotten smushed. Everything is down, but fangs and yields, which makes me think, if everyone's calling for a market top, I think everything else is just going to start to pick back up. And if the market's down, I think it'll just probably trek back up. And maybe Fang cool off and we consolidate for a little bit. But I think the broad market will probably continue to go up for the next few months unless something
Josh,
major happens.
oh,
And
Josh,
now let's look at the
before,
DXY. Oh wait, oh yeah. If you have
yeah,
some
so not
pushback,
so
I'd
much
much rather
pushback.
hear
Before
it.
we go to the DXY, there are two things that immediately come to mind. The first thing is that video with Lacey Hunt talking about, and it's maybe from 3 or 4 months ago now, so it's not the freshest, but it's certainly not old either, saying how you can have liquidity that gets trapped in the financial system. So it's not making its way into the real economy, but rather what's going on is that it gets put into asset prices, which bids up asset prices and sends yields down. That's the first thing I was thinking about when you were talking about that. Second thing, both of us follow Manarino, and Manarino likes to talk about his unholy trinity. And to be clear, and I know that this is not done to piss you off, Josh, but of course, what the Federal Reserve is doing right now is not printing money, but rather, I suspect that it's creating some psychological effect, which is causing people to put cash into financial assets. Because one of my big premises is that I read from another author that I really like is there's a great deal of capital seeking and not finding investment yield. So if you have $100,000, what are you going to do? Park it in a checking account? Probably not. You're going to park it in the market, damn whatever the price is. And so I think you're going to see a lot of that continue to push prices up. And this would be a question I have for you, Josh, is that do you think, no, probably say like this, a Venezuelan style melt up in the market versus a meltdown? Probabilities of something like that happening in the mid to short term?
Well, it all depends, because with the system right now, I see no. We will not see a Venezuelan type of stock market melt up, just because everyone would need to be a billionaire, and that would be in hyperinflation I do not see likely unless the system changes, because money can either be created by banks, which banks are not lending, or by the TGA issuing debt, and the Fed buys that debt, which is the economy. But there's a lot of political gridlock, and that it's at the speed that would need to happen for us to see a melt up of that kind. I do not see realistic. But let's say we see a market crash, and we see a 50% crash in the market. There'll be blood in the street. Everybody will be praying to our Lord and Savior, the government, and the government will say, hey, if we just let the Fed take over, and we'll give you an account with the Fed, we can directly give you money, so you won't have to worry about anything. Because dollars is wealth, so there's nothing to worry about. We'll set you up a bank account with the Fed, and will give you as many dollars as you want. Then the system would change, because right now the Fed cannot directly give dollars to people. It's not allowed. But if that changes, then I think a melt off like Venezuela is extremely likely. Only if that happens.
Gotcha. And so just to be clear, I very much agree with that premise that there is a chasm that divides the Federal Reserve and what they can do from the real economy. It's not to say they can't have effect on the real economy, but it's a secondary effect, a psychological effect, versus an actual legitimate effect, dollars being airdropped into somebody's account or whatnot. No, I definitely concur with that. And I also will note that I'm sure the Fed would not be too disappointed if a crisis arose that allowed them, or that allowed the politicians, I should say, cover to change the rules where they could cross the bridge. But staying on topic there, that kind of echoes my thoughts as well. But interesting conclusion there. Josh, I've also got the Dixie graph. Do you want to pivot to that?
All right, so we can see this is not the greatest graph, but for the past few years, the dollar has been in a trading range between I'd say about 93.5 and 89.21. As long as the dollar stays in that range, there's really not too much to worry about. But we've been hovering around the upper bound, and that has the market does not want to see a strong dollar. It can tolerate it, but it is definitely a headwind. And the more headwinds there are, the harder it is for the market to go up. I would say most likely my base case is the dollar consolidates, continues to roll over, and maybe we reach at that 89.20 level in the coming months. And that would be pretty bullish equities and a lot of the commodity producers that have taken a hit the past few weeks to months. So overall, I am pretty bullish on back to the reflation trade, and a lot of these super undervalued sectors. Like I would say shipping is one of those categories that I've been doing a lot of research on, but that's probably a story for a different day.
Just a quick follow-up on that front. Would you say that, tell me about your interest in a volatility play for the time being?
I always have a volatility play on, unless we see a March 2020 type of crash where then I would just exit the whole position. But basically, the going long fall is just a way to protect your downside risk to the market. And you can do it very cheaply for a lot of asymmetry. Let's say, right now, I don't know off the top of my head, but I'd say the VIX is around I don't know.
I'll check.
Whatever. The VIX is at a pretty, it's pretty cheap. And if you buy, say, a VIX index like the VXX, and we see a March 2020 type of crash, that is probably going to 5 to 10x. And if let's say you put 4% of your portfolio into a volatility hedge, and we have a March 2020 type of crash, that 4% is gonna say let's say the low end, we set it, let's say at 5x's, and that goes up 20%. Now you have 20% of your portfolio covered from a crash, and for only 4% risk. Me personally, I put that 4% on margin, because if the stock market goes down, that's going to go up anyway, and I'd rather have my other equities just in cash. So I think everyone should have a long volatility.
So follow up on that thing. Would you say it's more of an insurance, or would you say it's?
Yes, I would say that's exactly what it is. And let's say the more bearish I am on the market, the more that position. Let's say in a few weeks, everybody starts to turn around and everyone's bullish again. I will be adding to my volatility position and probably lowering on some of my other positions. So let's say right now it's 4% of my portfolio. I might increase that to 6%.
Okay, gotcha. No, I definitely agree that I think the volatility play going long in volatility, even if the market goes down or if it goes up, you've got yourself covered. As long as the market doesn't do exactly what it has been doing, you're going to win, and probably win in a big way.
Well, either way, that's only 4%. So if that's going down, that's only 4% of your portfolio. So, I think it is very, very.
So you would not necessarily advise, should we say, let's say a 90% allocation to
to anything. I don't care what you like. A 90% allocation is, I would say, not smart.
You might have a point there. Okay, so basically, as everyone can see, like over on that side of the screen, we basically just have a little graph of the Dixie right there, and going up, or excuse me, it's on the downtrend. But There's that. Okay, gotcha. And Josh, anything to add on that, or do you want to go on to BOA?
No, we'll talk about the next article where I think you can probably take it.
Okay, gotcha. So
And out there.
So this is something that caught my eye a little earlier today. Bank of America announced they were issuing $123 billion worth of bonds, or at least getting the authorization to issue those bonds. First thing that caught my attention was back, I think it was April 16th, Bank of America did the same thing, as well as Chase and the other big banks. And what's interesting is that they're doing it again. So one of the things that we keep hearing is, hold on one second. One of the things we keep hearing is that there's too much cash in the system. These poor banks have too much cash, too much cash, too much cash. So the question...
Specifically, when people talk about the
Yeah.
reverse repo, that is when people say the reverse repos are going up because there's too much cash.
So,
That's my
right, so you've got that going on as well. But the question I have is this, is that if it is true that banks do have too much cash... Josh, just a heads up, you're breathing into the mic. So, anyways, so if banks do have too much cash, why on earth are banks issuing debt to raise cash? This seems very counterintuitive, or at least it seems that there's a serious part of the puzzle that's being missed there. The other thing is that when I actually read through, and just to be clear, it was not me reading through this, rather it was someone else on Reddit who did a due diligence that I thought to be particularly fascinating, but the bond issuance, and Josh, I sent you the background of stuff this too, maybe a good topic for another video if we want to go deeper into it. But what's very interesting about the bonds Bank of America is issuing is that it's almost like a swap. So Bank of America will issue a bond saying, listen, we're going to borrow $100 billion, but we're only going to pay you, Mr. Bondholder, Mr. Buyer of the bond, based upon the underlying asset of the bond. So for example, the bond might track Apple, the bond might track Microsoft, Exxon, whatever, right? Now, if the bond goes up, that's going to be bad for the bank, at which point the bank has the right to buy back the bond, no questions asked. However, if the market goes away, or that is, if the underlying goes down, so in this case, if the bond underlying is XOM tanks or whatnot, then that means the interest payments due to the bondholder might go to zero. And it's also very possible that if it goes low enough, there won't be any principal returned as well. And I want to say that reading through, although I can't cite this in my mind, so let me just say the guess, shooting from the hip, was 80%. If the underlying fell beneath 80%, basically the bond becomes worthless. In that regard. Either way, the question I can't answer, and if anyone else can, I'll be very curious to hear it, is why in the hell are banks raising cash if they have too much cash in the system? That doesn't seem very... There's a piece of the puzzle we're missing. And that's what's confusing me about that. Josh, you want to add anything?
Something that I find very interesting is a few days ago, the Fed issued a repo facility, which right now the Fed's doing has a reverse repo facility open, which is like at all-time highs. As everyone knows, it just hit $1 trillion, right? But if they just issued a repo facility, they need collateral with the reverse repo facility. So why would they open a repo facility unless there was risk in the system? And I think because a lot of people will say that the Fed are dummies and they don't know what they're doing, or at least they know people that know what they're doing. And if these banks are telling them, hey, like, we are unstable and we need help, the Fed is going to help them. And if they open a permanent repo facility, I think the only reason is if there's more risk in the system. And as we can see, if B of A is issuing debt, then they are probably actually has a lack of cash.
Yeah, exactly. If there's too much cash, right, they're raising cash. Also, another thing to add too, Josh, looking on I'm just on the New York Fed's website right now. While there has been a frequent and heavy usage of the reverse repo facility, just scrolling back as far as I can go on my phone, regular repo, 0. Now, I don't know if this program is the same as the permanent facility. My assumption is yes, but don't hold me to that. Either way, the point remains regular repo usage has been at 0, while reverse repo usage has shot to the moon.
They also did it with foreign entities, so for the Eurodollar system.
Reverse repo or regular repo? Or both?
Regular.
Regular?
Regular.
It's interesting.
Definitely something that we could look into further.
Yeah.
It's all the data I have right now.
Yeah. Okay, well anyways, Josh, that seems like, let me, hold on one second. Let me just turn off, because I worked on these transit, there we go, fade away. So long, B of A thing. Anyways, well that seems like a good first draft to see how this works out, get some feedback. Josh, you want to add anything to this?
Yeah. Nope. If anyone's watching, And until
Next
next
time it is. Take care, guys. Bye.